Spread betting and margin trading. Spread betting offers considerable advantages over share trading for active and experienced investors. Traditional share trading requires one to purchase shares on a per-unit basis. In other words, if you were considering buying shares from XYZ company, which are trading at £10 per share, and you were to purchase 100 shares, then your initial outlay would cost you £1,000, which is simply £10 times 100, £10 for every share that you owned. Now, when trading on margin, you are able to purchase more stock with less capital. This is called leverage. Margin acts as a deposit to cover any potential losses that you may incur while holding a spread bet position. If the margin requirement is set at 10%, then you will be required to place 10% of the value of your trade as a deposit. Thus, a 10% margin of a £1,000 trade equates to a £100 deposit. Now, to place this deal, you are only placing a fraction of the value of the trade as a deposit. Quite simply, you are able to increase your profits using a much smaller capital base. So when purchasing shares in the traditional manner, you are required to have the full amount of capital available before you buy the shares, compared to margin trading, where you are only required to have a percentage of the total amount as a deposit. Deposit margin. Financial spread betting is a very good example of margin trading. The spread betting provider will decide on the margin requirement you are required to deposit to open a trade. Some traders refer to it as initial margin, others call it the deposit factor or the notional trading requirement. Whatever the case, it's the cash deposit needed to open a position. So for instance, if stocks in William Hill are trading at £156.10 and you wish to purchase 5,000 shares instead of having to pay the full purchase price, which would amount to $7,805, you might only have to put down 10% margin, in which case you would only have to tie up £780 and 5 pence of your funds. This also means that spread betting, being a margin traded product, allows for a much greater exposure for a given deposit. Now, rather than buying only 500 shares, you could deposit a margin and have exposure for 5,000 shares. Therefore, you might only need 1,000 quid to purchase spread betting positions in different stocks up to a value of, say, £10,000. If your investment rises to £12,000, equaling a £20 rise in the value of the position, you will in fact make an incredible 200% return on your initial investment, as you only invested £1,000 initially. Risk of margin trading. The risk here should be clear. With such generous margins, it might look tempting to take on a much greater exposure, and should the market start moving against your position, it means that you will still be liable in the same way as if you would have bought these shares and paid the full purchase price. If a position is opened and goes against your desired direction, the losses can be magnified. Even a small bet size can turn into a big loss if the trade is not managed appropriately. So you really have to use judgment and utilize margin with care, and trade with a disciplined approach so as to avoid any nasty surprises. For more information, visit www.spread-betting.com.